He is the man who broke the Bank of England with George Soros, and now he is speaking out against what he calls generational theft. He's Stan Druckenmiller, founder and former CEO of Duquesne Capital Management. Stan, when you and I sat down in the spring, you urged everyone to start focusing on this idea of generational theft. You went on to speak at your own school, Bowdoin College, and you really rocked the campus, warning students that they need to pay attention to the fact that senior citizens could be stealing their money. You're about to embark on a full-on college tour. Why is this so important?
It really solidified to me during the sequester period when the whole debate was going on about cutting government spending and our fiscal issues. And that's when I first came to understand the lack of knowledge on this topic, not just from seniors, but future seniors. And if you listen to the sequester debate and spending and where the debt is, I find it inconceivable that they didn't know the facts, including, I would be surprised if the president knew the facts, given the statements he was making. During the sequester, you may remember, he said, we're not going to balance the budget on the backs of our seniors. And if you look at the situation where we are today, seniors have doing very, very, very well for the last 35 years. And it's been a remarkable accomplishment, actually. And because they've been doing well, the poverty rate among seniors is down from 35 to 9%. But their wealth has also increased dramatically. And looking forward, we have a very tough picture because of demographic situation. Seniors about to explode as a portion of the population, and the benefits we've promised them, there's no way to cover them given the current situation we have.
Stan, in many ways, the facts speak for themselves, and you've brought charts to help illustrate the points that you're making. Here's the net lifetime benefits by age. Clearly, if you're not born yet, you're going to be in deep trouble come the future. Why is it, do you believe, so many people are so tragically uninformed, ignorant of these facts? Do you blame the voters themselves for ignoring these issues and favoring short-term concerns, or do you put the blame at the feet of politicians in Washington, or both?
I'd say both. You know, this is a country of special interests, as we all know. As we all know, old people vote, or seniors vote very consistently. Young people don't. Young people have other interests than, say, their future economic situation at the age of 20. I sure did. They're not necessarily focusing on this stuff at that point in time.
So part of what you're doing, it sounds to me, is encouraging, once these younger people have the information that you feel they need to have, get them out to the ballot box and vote with their consciences?
Oh, it won't be their consciences. They should be mad as hell. But let me also say, part of what I'm doing is to inform seniors of the situation.
Do they care? They're getting the money.
I'm sure they care, Stephanie. Maybe some don't. But I would bet a lot of money that 85% of seniors today, if they knew the numbers we're going to go over, they wouldn't be comfortable with this is what they were leaving to their grandchildren and their great-grandchildren.
What numbers? What are you uncomfortable about?
Okay, can we go to We're a Nation of Takers? Do you have that chart?
We do. Let's pull it up.
Okay, so let's first set the table looking at what's going on the last 35 years, and then I want to get into the demographic problem and why it gets so scary from here and why I don't understand the current dialogue that's taking place over this situation, because it's completely uninformed. This chart up on the screen is federal government entitlement transfers as a percent of the federal government budget outlays. And as you can see, if you go back to 1960, when I was 7 years old, about 28% of federal budget government outlays were transfer payments, or what we call entitlements. That number has gone up to 72% over this 35-year period. Now, the problem with that, first of all, the good news on that, as I said, seniors are much better off. It's been a tremendous accomplishment. Poverty rate is way down for seniors, but these are transfer payments, and there's no productive investment or no looking to the future coming out of this. And if you look at how we got from 28% to 70%, almost all of that money went to the elderly. If you took an elderly person back in 1960, 28% of federal government outlays per capita went, 40% of government outlays per capita went to them. That number is 71%. Where did that come out of? It came out of children. It came out of investments in things like education, infrastructure, things like that. And that crowding out effect creates a problem going forward because these are not productive investments.
And we haven't even gotten to the point yet where baby boomers, for the most part, are retired, beginning to collect their entitlement checks and programs.
Yeah, before we get to the demographics, can we put up the wealth chart?
The change in average net worth by age group?
Yeah.
Let's pull that up. Stan, since you've started all this, though, when you're putting out these numbers, you started having this conversation in the spring, what kind of response are you getting? What are the Mark Zuckerbergs of the world who are influential with young people, what are they saying?
Well, the answer is I don't know. Jeff Canada and I, who's my partner in the Harlem Children's Zone, well, I'm sort of just a tag-along, but we went up to Bowdoin College just to see where this went. First of all, after your show, I had a number of people contact me, which was unexpected. I didn't really know where it was going to go.
A lot of people watch this show, Stan.
Apparently. I certainly do. So we went up to Bowdoin College, and we gave a presentation just trying to outline the facts of what we're looking at the next 30 or 40 years, and the response was overwhelming. So based on that, we're going to do about 10 to 12 colleges in the next 2 months, and I'll check back to you what the response is. Mr. Zuckerberg is obviously right now more focused on immigration than on this stuff.
All right, well, should we go back? Let's look at this net worth by age group.
Yeah, because I think this is really important in shaping the debate. We've always heard this term, you don't want to leave the next generation with less than the current generation. This chart, when it was first shown to me, and it's from the Federal Reserve Board survey of consumer finances, is kind of shocking. Because of the previous chart I showed, where these transfer payments have gone primarily to the elderly and they've been substantial, look at what's happened. If you are a 29 to a 37-year-old in this country, your net worth is less than a 29 to a 37-year-old was in 1983. This is a staggering statistic. So this is the first generation where a 30-year-old is worth, literally, his net worth is less than his parents. But if you look at the older people, their net worth has doubled over this time period, again, because all this money has been transferred.
Stan, I have to ask you, though, do you not worry, let's go back to Bowdoin for a second, because do you not worry that people look at you, Stan Druckenmiller, and say, you know, here's a middle-class kid from Pittsburgh who went to Bowdoin, pretty fancy New England college, made $1 bazillion as a financial speculator.
Technical.
Why should I listen to him?
Well, immodestly, the way I would answer that is the way I made my money in the industry wasn't necessarily in stocks. I made most of my money in the bond and the currency markets, trying to forecast future economic trends and problems that I saw happening. And one thing that I'm not very proud of is if you look at my record, the big years were in bear markets and chaos. I tend to take great advantage of catastrophes happening in the marketplace. In other words, for whatever reason, maybe I have a dysfunctional personality, I was good at looking around corners and predicting them. And this is much longer in time frame, but it's the easiest layup I have ever seen of something we got to address and a problem we got to deal with.
You supported President Obama in 2008. What's changed for you?
Well, I was drinking the hope and change Kool-Aid. I thought he was a younger generation. I think by hindsight, looking back, he probably needed more experience for this job. I also thought he would be more Clinton-like and move to the center, and clearly he hasn't.
Al, Stan Druckenmiller is hardly the only member of the financial community whom President Obama lost in the last election, yet it didn't stop him from beating Mitt Romney. Can the Democratic Party count on the kind of support that it had, and certainly the great ground game that it ran the next time around?
Yeah, it depends on who the candidate is, depends on what the country's conditions are at that time, Eric. I can't tell you what's going to happen in the Senate or House if they vote on Iraq in 2 weeks, much less what's going to happen in 3 years. Stan's got a problem, though. I understand exactly what he's saying, but he's got a problem with the Republican Party, too, because they not only have not moved to the center, they've probably moved a little bit further right. So that really, I think, epitomizes the dysfunction. I don't know what a guy who cares a lot about these issues like Stan Druckenmiller does.
Well, I'm an independent, and I'm just hoping one candidate on either side in 2016 shows up. But let me ask you the question, because Eric asked you a great question about Washington. Pay attention to this problem. We showed a slide earlier where the unborn are going to receive, given current tax schedules and current entitlement benefits, they're going to be a net payer of $400,000 more than they're going to take in terms of payments from the government, whereas the average 65-year-old today is going to take in $325,000 more. This is a terrific study that was commissioned by the Can Kicks Back, a group of young kids, through one of my favorite economists, Larry Kotlikoff, in Massachusetts. But how in the world does anyone in Washington think it's fair, because all I hear is fair and balanced, not just on a certain network, but from all the politicians, that a current senior should get $700,000 net more than a future senior? What is fair about that?
Well, it's not only not fair, Stan, but it can't be sustained. And what I think, though, is that people sometimes neglect that, at least in the medium term, the fix is not that painful. It's not like you have to take away grandma's Social Security. It's not like you're going to put sick people out on the streets. You can go by adjusting the cost of living index for Social Security, perhaps gradually raising the retirement age on Social Security. I wouldn't do it for Medicare, because those people still have to be taken care of, but doing other Medicare reforms, more efficiencies. You can go a long way towards addressing the issues that you raise. The problem is there's not a political will, because in order to do that politically, and I think this is the way the public feels too, you also have to add a little bit of revenue in there. It's not hard. That's not that painful. It ought to be done. It just is the political polarization dominates instead.
Stan, could the right Fed chair, could a new Fed chair be somebody to help grease this system that is so broken? And is that person Larry Summers?
I think we're out of the purview of Fed chair here, Stephanie. This is
a political problem?
A political problem, but everybody who's in D.C., no one seems to want to fix the problem. If you bring somebody in from left field on a completely different venue, could that help the situation?
No. I mean, Larry Summers, Janet Yellen, others already have a platform to discuss this issue if they want to. You don't need to be Fed chair. I really believe, and I'm probably naive, that if we get the facts out there and show them exactly how big the problem is the next 40 or 50 years, and show them the inequity in the system. I don't think most seniors know that they're getting this much more than their grandchildren and their great-grandchildren will get. We can get the political will.
Stan, how far are you prepared to go with this? Because what if it takes more than a speaking tour, for example, at colleges in the United States and interviews like this to get people's attention? I'm thinking about Pete Peterson. He's been talking about this issue for more than 20 years. He started a foundation. He's written 6 books. He is reading from the same, or singing at the very least, from the same song sheet for the most part that you are.
I don't really think so, Eric. He is focused more on the debt and this big debt catastrophe that's about to happen. This thing's going to get solved one way or another. What I'm more focused on here is generational theft, the inequity between one generation and the next. We can solve this problem tomorrow morning. All you have to do is raise everybody's taxes 55%. That's not going to happen. And I mean payroll taxes, income tax, everything. We could also cut spending 36%. To me, it's not just about the debt. It's about informing seniors that future seniors are going to be bearing so much more of the burden than they are.
And you really think those seniors are going to start voting basically against themselves?
The seniors I know will. I mean,
You probably know really rich ones.
I don't think the ones that went to, I spoke at Bowdoin and I spoke at the Princeton Club, and the seniors seemed shocked and very supportive after they heard the actual numbers.
Al, you have a final thought here?
Well, look, I think much of what Stanley says is right, but Stanley, you also, to get this done, you've got to go to the country club and the yacht club and the Princeton club too, because some of these people are going to have to dig in their pockets and pay a little bit more money. That's also a price of making this work.
I've been to these places, and one of the reasons I'm so excited by this study that Kotlikoff and the Can Kicks Back put out is one of the things I hear from all these people is it's my money, I put it in there, I earned it. No, you didn't. You're taking out $350,000 more than you put in, and you're leaving a $400,000 debt for your unborn great-grandchild. And I happen to believe if these people are well informed, maybe I'm just too optimistic. I think they'll be willing to give up some.
Clearly, on the long-term basis, you have a very negative outlook, but it doesn't mean you shouldn't be long the market today. What are you doing investing-wise?
Not a lot. I don't want to hedge, but I probably have the smallest positions I've had in. I had some big positions earlier in the year. I'm sort of sitting and waiting. There's a lot of uncertainty over who the next Fed chairman will be, what their attitude toward the diminution of QE will be. You've got the whole Syria thing. I like to be very patient, and then when I see something, go a little bit crazy, and I just don't see anything right now.
A lot of people have told me and Stephanie that it doesn't matter who the next Fed chairman is, whether it's Janet Yellen or Larry Summers. The policies aren't going to be that much different. I take it you disagree.
Oh, it totally matters. I mean, when you think back of what Paul Volcker, Alan Greenspan, and Ben Bernanke have meant to markets, it's pretty naive to say the next Fed chairman won't matter. They may not know why it matters, and I may not know why it matters, but it is a really, really important appointment.
But do you have any idea how either of those two candidates would run the Fed and what kind of an impact he, in the case of Summers, or she would have on financial markets as chairman?
I don't. There's market consensus, and I have my views, but I probably wouldn't want to share them on national television. On which
you don't strike me as Mr. Consensus, though.
You know, again, I'm not going to bite on this one, Eric.
Well, so let's say, so your positions are smaller, you've cut positions, but what are you doing? Are you not completely sitting in cash?
Okay, so my guess is, and I believe the market is topping, but you know the economists have the stock market predicted 7 out of the last 3 recessions. I predicted 7 out of the last 3 bear markets. I started in a bear market in '76, so I'm kind of poisoned. I have a bearish bias. But where I am on the market right now is if you gave me a stock I really like, I'll buy it, and if you gave me a stock I really hate, I'll short it. But in terms of having some big position, long or short indexes or some exposure to the stock market, right now I'm lost, and I don't play when I'm lost, and I know in the future I won't be lost, and I'll play big then, but I don't.
You can sit in cash because you're managing your own money. Clearly, you ran a hedge fund.
I could sit in cash when I was managing other people's money, Stephanie.
Well, for other managers out there, can they say, I'm going to take 2 and 20 and not invest?
I don't know. The way I always approach the business is you give me a pile of money, and I'm going to try and pound that money for you over time as best I can. This whole quarterly performance and risk-adjusted stuff that's invaded the hedge fund industry, I don't get it, and frankly, for other than 10 or 15 managers, I can't imagine why anybody would pay 2 plus 20 to what's out there. You know, when I started in the business, there was me, George Soros, Julian Robertson, Paul Tudor Jones, or Bruce Kovner. We were
couple of jokers.
We were expected to make 20% a year in down markets. There was none of this, oh, I've got a risk-adjusted return of 8 and this. That's how 2 plus 20 came about.
So why are hedge fund managers so much less successful now than they were then?
Well, there's just too many of them. There were 8 to 10 back then. Somehow, 9,000 people are pricing their product off of 8 to 10 people's historic performance. And I noticed in the late 90s, early 2000s, a lot of the smart early investors in hedge funds, clients, were leaving, but they were more than replaced by state pension funds, sovereign wealth funds, and so far they've been perfectly happy to get returns that our early investors would have never tolerated.
Do you invest in other funds?
Yes, I do.
How do you make a decision of who you want to invest with?
I meet with them, and luckily I've been in the business 35 years, so I think I have a pretty good edge about what makes them just go over their investment philosophy and see whether they can make money over time.
As a hedge fund manager or a former hedge fund manager, what do you think about the media circus around credits like Herbalife and all these big personalities and names involved? This isn't the way Stan Druckenmiller invests.
Well, to each his own. I'm surprised because I always thought that publicizing your positions was not a good thing. It might be great for a day or two, but these people forget you got to get out of these positions.
But when you watch all this, you don't suddenly say, you know what, maybe I want to go long Herbalife here. Maybe I want to go long Apple.
The only time I really got interested in Herbalife is when you guys did the show on Bill Stieritz. That got my attention because that's not some guy that's trying to do a day trade or somebody's short or this or that. That's a serious investor, and that would get my attention.
What else is getting your attention these days?
Well, I'm very focused on the new Fed chairman, and I'm perfectly willing to wait a few weeks to find out.
So that leads me to a question. If you've got you were saying earlier, the smallest positions that you can remember, right? You may have ever had?
In most things, yes.
Okay, so, and you also have a great track record calling bear markets.
Yes.
So, if...
By the way, it's not that great because I've called bear markets that didn't happen.
How does it feel to you right now? How close are we to a bear market?
As long as the Fed is printing money, not very close. That's why the issue of tapering and where we go with it is so important. I don't really care whether we go to 70 or 65 in September. But if you tell me QE is going to be removed over 9 or 12 months, that's a big deal because it's my belief that QE has subsidized all asset prices, and when you remove that subsidization, the market will go down.
So asset levels for asset prices, right, that would suggest that a lot of what we see in asset prices is illusory, that if you take the Fed away, the fundamental underpinnings just aren't there.
My first mentor and boss, Doc Drellis in Pittsburgh, used to tell me it takes hundreds of millions of dollars to manipulate a stock up. But the minute you have this phony buying stop, it can go down on no volume, and it can just reprice immediately. I personally think as long as this game goes on, assets will stay elevated. But when you remove that prop, and let's face it, the Fed has said they're targeting asset prices, those prices can adjust immediately. June was very instructive because if you didn't believe before that the exit was going to be tough, the mere hint that maybe in 3 months, if the economy's good, we might go from $85 billion a month to buying $65 billion a month caused that kind of havoc and risk around the world. How in the world does anybody think when the actual exit actually happens, prices are not going to respond? It's silly.
Stan, you said you have the smallest positions in most things. Most things has me thinking, well, what do you then have big positions in?
I don't have what I would call it takes courage to be a pig positions in anything. I am long some Japanese equities. I am short some yen. But in terms of big outsized bets like I had earlier in the year in something like Australian dollar, or frankly, my bets in Japan were bigger earlier in the year, everything's sort of down and waiting for the next big shot.
You're George Soros' former business partner. You and George worked together for many years. A couple of years ago, George told me that hedge funds can be very destructive to economies, in particular because they're always looking for weak points. And now that he's not speculating any longer, he's on the side of the angels. Now, whether George is on the side of the angels or not is a matter for debate. But what's your view on hedge funds? Are they a force for good or a force for evil?
I'd say they're neither. I'm surprised George said that. I'm sorry I missed that show. What I would say, and because George is more in the macro world, is that specifically he's probably talking about currencies. I mean, I would think that would be the best example. I've made some currency bets, and if you don't have the fundamentals with you and they're not right, you may win for a little while, but you're going to lose. And I will always believe, you brought up the British pound in the pre-show.
And you were talking about the Aussie dollar just a few minutes ago.
Yeah, that was a good event for Britain. On the other hand, there's some...
A good event, why? Because it hastened the inevitable?
Because they were linked to the German economy, which had just done reunification. They had an inflation problem and were exploding in growth. Germany, Britain had a housing problem. Interest rates were too high there. You could not have had two more dissimilar economies, and they shouldn't have been linked. And what happened when they broke the pound, they were freed up to follow an interest rate policy that was consistent with their own country's needs. And in fact, not to be an apologist, but that came to be known as White Wednesday a year later as opposed to Black Wednesday. And gilts went crazy, the stock market went crazy, and the British economy recovered. On the other hand, I've made some bets that have been dead wrong, and the market punished me.
Well, I want to go back to QE. If you think about QE and what asset class has been manipulated most because of it, would you say stocks or bonds?
Oh, I would say stocks. I have been really wrong on the bond market in the last 3 or 4 months.
How?
I have been waiting for this decline for 2 years, and I completely missed it because, first of all, the stuff we're talking about earlier in the show, that's too far down the road, in my opinion, for the bond market to pay attention of. But I have always found in bonds, if you can predict a relative change in the economy relative to consensus, you'll make money in bonds if you get that equation right. And 2 or 3...
Even in a world of QE?
Yes. And 2 or 3 months ago, I thought people were overly optimistic on the U.S. economy. It's my judgment that that assessment turned out to be correct. But bonds went down anyway for non-economic reasons because we have the unwind going on. And for whatever reason, while I anticipated that down the road, I did not think it would happen while the economy was softening.
Well, are you concerned that we're not going to be focused on the economy again, or at least those in D.C., because we've got Syria to focus on?
Oh, I think we'll always be focused on the economy. I am a little concerned that the Fed chairmanship appointment could get hung up. I think it should have already been made. It's become a complete circus. You've got economists opining on it. You've got politicians opining on it. You've got newspaper people. My God, Obama should just go in the Rose Garden and appoint whoever he wants to appoint. That's his privilege and his job.
Stan, I want to go back to how we started our conversation and try to pull it all together. Generational theft, this idea that entitlement programs are effectively stealing from future generations. How do you put it all together? How does your investment philosophy reflect your personal views?
I wouldn't say it's my investment philosophy. It's just a concern I have. And let me say, when Al Hunt said this is easily fixable, I think it's a mistake most people make in investments. They look at the present instead of the future. And if you analyze the debt as stated out there, it looks like it's fixable. We do a little chains here, a little chain here. Eric, that's not the case. Those charts we showed earlier had no demographics in them. What's going to happen now? Because 1947 is when the baby boom started, and fertility rates were over 3 then, and they're 2 now. For the next 20 years, every day, 11,000 seniors. Every day, we're going to have 11,000 new seniors. And this is going to make the numbers of seniors who are getting entitlements explode relative to the working population. So instead of having 5 workers supporting an entitlement, you're going to have 2.5 workers. And that is not on the government balance sheet. When you hear this stuff about the national debt being 12 trillion or 16 trillion, depending whether the Fed or the Treasury owns it, if you actually took what we've promised to seniors and future taxes and you present value both of them, that number is $200 trillion. That is the problem when you take the debts of future payments to seniors and put them on the balance sheet, and for God's sake, they should be on the balance sheet. And in fact, I mentioned an organization earlier, that the Can Kicks Back. They have sponsored a bill in Congress, the Inform Act, which will bring that. So,
true transparency.
True transparency, which is a Bloomberg hallmark. We need at least to get that on the books so people see it. The other thing that annoys me on this problem, and then we can move on, is All the solutions, even Paul Ryan, who got absolutely lambasted, you know, pushing grandma off the cliff, even he said, let's exempt everybody 55 and over. Why? They've already gotten this huge share of the pie, and this problem is compounding away. So if you don't address it today, the problem is going to be much bigger in 10 years, 20 years, and 30 years. Hugely different.
But I got to say, today we're also almost 5 years away from Lehman collapsing. How do you look back on the last 5 years and say, what are the mistakes we've made, and could we make them again?
Okay, so I find the situation somewhat bizarre, and it's a little bit colored by how I thought we got into this. And I actually did well in the financial crisis because I believed this was the reason we got into it. And I'm not saying it was the major reason, but a necessary condition to have a financial crisis, in my opinion, is too loose monetary policy that encourages people to take undue risks and go out on the risk curve and do silly things. We should have shut this down in 98, 99, the NASDAQ bubble. We should have raised rates. We didn't. Then when we got the implosion, the Fed eased in 02 because they were trying to offset what happened in that decline.